Good morning, traders. Happy Monday to you. It's 8:02 a.m. Chicago time on the 14th of December, 2015. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. Quite a few items overnight or over the weekend. Some of them affecting the trade, some of them are not. Delegates in Paris reach an agreement on climate change accord. The agreement has no enforcement mechanism. Not sure it's a step forward, but I think the politicians are making it sound a lot bigger than it really is. China's state-run news agency Xinhua says several officials have admitted to fabricating economic data to show higher growth than obtained. In one instance, Liaoning gross domestic product was reported at 9.5% 3 years ago and is now being reported at 2.7%. The news agency is saying the upside is when you compare what was being reported falsely to what is there now, it doesn't look so bad. So I think I've said it before where you got to look at those Chinese numbers with a very cautious mindset. Netty gas is trading at 13-year lows. Unreasonably warm weather has dried up demand for natural gas, pushing its price down to $1.881 per British thermal unit. Really cheap. Eurozone October industrial production came in at 0.6%, doubling the estimate of 0.3% year on year, 1.9% versus 1.4%. Here's the one that's moving us, I believe. Emir Hussein Zamaninia, Iran's deputy oil minister for international commerce, said there was absolutely no chance the country would delay shipments and withhold crude oil deliveries when sanctions are lifted. West Texas Intermediate Crude (WTI) oil was trading at 34.53 on the low on the January contract. If you superimpose the chart for crude oil over over the S&P or whatever, you'll see that they're trading in sync once again. Fed watcher Hilsenrath says the FOMC is likely to raise rates this week, starting tightening to about 3% in 3 years. Fed officials still worry rates may have to be brought back to zero later. Again, I still hold that there's little to no chance of the Fed doing anything with rates right now. What's on deck for today? Really nothing. I don't see anything on the calendar today of consequence. We're looking at one speaker at 9 Central, 10 Eastern. We have ECB speaker Costa in a conference in Lisbon. And looking at, since it's Monday, looking at the weekly calendar, tomorrow we get UK PPI, CPI, RPI, European employment, and a zoo survey in Europe and in US Empire, manufacturing and CPI. Germany, Wednesday we get German manufacturing and services, European manufacturing services, trade balance, and CPI. UK unemployment, US building, housing, permits, industrial production, manufacturing, and the rate decision on Wednesday. Big day. Thursday, Germany has the business climate number. UK has retail sales. U.S. jobless claims, current account, Philly Fed leading index, and ECB's economic bulletin. Friday, we have European current account, U.S. services PMI, and Fed's lacquer. That's how things are shaping up. So a lot of numbers sprinkled throughout the week, with the key release, of course, being the Fed rate decision on Wednesday. With that being said, let's switch over to our charts. All right, so on Friday, the expectation for what it would likely do on Friday, for the primary hypothesis on Friday, was for a potential response of buying back up into the prior day's low, which was up here at 2035.75. So expected responsive buying up, but I expected failure and then a rotation down, a chop, and then for us to start moving down towards that 2004 area. And that's basically what we did. We got up. We didn't get as high as I expected. We got to 2025.50. And overall, the market was pretty weak. It traded reasonably, though, on Friday. The rotations were pretty fairly clean. Several mid setups, mid initial touch setups on new lows throughout the day that worked out nicely. This one worked out perfectly here. A low pullback to mid VWAP, and then continuation. The market, we ended up with another neutral day. So we had a normal variation day the day before. So we had neutral, normal variation, and that resets the clock. We have neutral now, and we broke the IB high early on, and then we broke the IB low, and then we continued below the IB low in the afternoon. So with that being said, the shape of the profile says a lot. I'm going to switch to a weekly here to show what that's saying. We shifted the point of control down right here at the end of the day. We shifted the point of control down. There was a lot that triggered at the low of the day. A ton traded on the close there, shifting the point of control down, giving us a neutral extreme close. With the point of control being where at the low end of the day, a poor low. The expectation is we're likely to see a lower low overnight, and we did. The market traded down to 1991 quarter on the March contract. Today is this week is expiration week. Friday is quad witching Friday. So there's going to be some jockeying of positions, delta hedging, and so on throughout the week. So we're likely to see some pretty quote unquote odd aggressive moves throughout the week. Generally, if I was to take some time off, this would be the week to do it. So with that being said, today I do expect this to continue lower, to test lower in the day session. The overnight range is pretty high. The overnight trade was pretty wild. But if you look at how it's traded versus crude oil, you'll see that there's a strong correlation once again between the ES and crude oil right now. So if we look at the overnight, here it is. We open up, test lower, the Asian session climb, and then the European session comes in. We have our economic release back here, the industrial production number, and then we sell off hard from 2014, from about 2014 to 1991, about 23 points, and then we bounce up. We had a small retracement here on the mid of this move. This is a setup for me. But overall, it's showing strength again. Now look at this chart closely. There's quite a bit of volatility, multiple distributions. There's no consensus. This is emotional trading. This looks like emotional trading, panicky trading, so to speak, rather than consistent shift and acceptance of value lower or higher. This is more of a pop, drop, and roll type of craziness going on. And so if we look at the crude oil chart, you'll see that it has the same pattern, an attempt higher, and then it breaks below, and it pushes right back through the mid here. We are trading in sympathy with crude right now. It's at its lowest for about 7 or 8 years. It's definitely driving the trade in my opinion. So With that being said, let's look at the overall picture of what we've done. What you're seeing here is a weekly chart. Each one of these represents a week. So this would represent last week right here. Okay. So last week opened right up here, and this is where it closed, the asterisk. Okay. And based on the trade, how it traded last week, you could see that Monday was right there. Tuesday came in right here. It's purple. Wednesday's red. Thursday's green. And then Friday's blue. It was fairly orderly. The selling was fairly orderly until Friday, where we gapped down. We left a gap behind, and we continued lower. And we closed way down here. We're trading out of balance. So this box has been our balance zone for quite some time here. And it's all of a sudden we're trading out of balance. Looking at inventory over this balance range, I am showing, and this could be wrong, it's a rough measure, I am showing the inventory to be short and heavy short on the downside. So this is important. Even we've been selling off, we have moved out of the balance zone that we've been in for quite some time. Again, the balance zone started October 22nd, and we have been going short. The delta's been fairly strong through it. Of course, we had rollover Thursday. The delta's Thursday, Friday is going to be odd, but overall, the speculative position is quite short, is heavy short, and in those circumstances, there's a high probability of a pop higher when that happens. Remember, we're trading in a balanced market, intermediate and long-term trend up, and we are selling off. And so there's a good cause for the longer time frame to continue to trade from that direction. The trend is still up. Also, we have the seasonality, the Santa Claus rally, and all that stuff. So what I'm saying is, I would be very cautious with the shorts, even though the shorts paid off last week. But overall, we've pushed into the next area beneath us. So you can see here we've formed an M, and we've pushed a little bit out of balance. We're trading on the edge of it right here, this yellow line. Do not be surprised today if we see a push lower, lower low, and a forceful push back up into that balance area to test out the next LVN, which is also the value low at in the 2045 area. The 2045 area. Initially, we have some play here at 2024-25. That was Friday's high. Also, we have this LVN to play, but the key play above, the key resistance above, is going to be the 2045 area. So I would be very careful getting short. I think if you were short, say last night, you would have seen that the market was really giving you a lot of trouble. Even though it ended up selling off, you would have noticed that it is giving you a lot of trouble on the short side as far as a payout. Generally, payouts on the short side are fairly quick. Friday's session had some pretty heavy volume, but we cannot pay attention to volume right now because of the rollover. Open interest has to move from one contract to the next, so volume is going to be higher anyway. So if you look at a daily chart over a long period of time, you'll notice that the market peaks up. So this is the September. This is a September volume. This is a December volume of last year. This is the March volume, not too much. Here's the June volume. Here's another set of September volume. The market tends to peak up volume-wise around expiration, rollover, and expiration. So volume's not telling us too much right now. But the range on Friday was right on the edge of one standard deviation of or what we would consider to be normal. But in any case, when we look at the profile, the combined profile, the composite profile of what we're doing, I would say that it would seem to me like the market is getting a little heavy on the short side. So I'll try to post a chart later on today with a correlation, one with crude and the other with showing the delta in the balance to show how we might be a little heavy on the short side, which sets up a run upwards. Okay, so just keep an eye on that. Let's shift this forward. And you can see the balance zone that we've been in. We tested beautifully the 72 back here, the MC point of control. We've traded a ton around the MC point of control to form this balance. We've been stuck up here for quite some time. We pulled back down, pushed through, pulled back down, tested to it, and we have formed a push down as expected, as I talked about. Hypo 1 worked perfectly on Friday, but again, be cautious today. An attempt lower could be bought pretty strongly, pretty severely. And we also have the FOMC coming in this week. So this week, I'm expecting this week to have a lot of action, a lot of volatility. So keep an eye on that. The primary hypo for today, in going with what we have here, I'm switching time frames, and going with what we have overnight, we are against the point of control. The point of control is in line with yesterday's point of control or Friday's point of control, so we have a little bit of balance here. I expect a choppy open. I would expect an attempt, at least an attempt at that low at 98.50 down to 2,000. Again, 2,000 major strike price for this expiration. I would expect a push down, and then I'm looking for it to start ripping up and challenging that that overnight high. That's my primary hypo. Anyway, there's a lot to cover, but I'm over my time. I'm going to leave you with that. This is likely to be a great week to trade, despite the expiration. But I would save your bullets for Wednesday. The expectation is that we will get a surprise on Wednesday, one way or the other. Take care.